love it.
Trade my spot.
Yeah.
We'll try that again. We'll call the meeting to order on May 2nd at 1:38 of the Valley High Operating Committee. All members are present. Be noted. Do I have a motion for approval of the minutes?
So moved.
Second. Mike Shorten moves, Terry Bruno seconds. Any discussion? All right. All in favor say aye. Aye. All right, the motion passes. We don't have any members of the public, so we don't have any public comment. Are there any member comments?
Yeah, I have a comment. I am curious why this meeting doesn't take place at the administrative center. At the administration center.
Well, if I can respond? Well, because it's Valley High, so they thought we could meet at Valley High, because this is where it all happens. We can meet either or. I guess it's at the pleasure of the committee. If you would prefer to meet there, that's fine.
I just think after having to cancel when we had the COVID thing, we didn't meet, that is there some wisdom about not having us coming into Valley High, and then would things like setting this up be easier if we were at the administration center rather than here? I mean, it doesn't matter to me. We travel to either place, but it just seems to make sense to keep all the meetings there, to me. And that's a member comment. We don't have to
Discuss it, right? It could be a comment to discuss in the future. I do know, so transportation does take place at the transportation department across the street. Probably pointing in the wrong direction.
And that's because we have so many staff in the meeting
Right.
there, so it doesn't make sense to take the staff out of that building and bring them over. The only thing I don't like about here is when Scott does his little chart up there on the screen, I can't see it here.
Yeah.
I don't know.
That's my only problem, but I actually like being here.
I think the cookings, I
That's
think
right.
you're gonna.
I told you you would go.
The cookies are really good, but I don't eat sweets, so.
I want one for you.
I would be interested, Tom, you do let all of your staff your staff working, but the residents, they are all familiar that the meeting's taking place? Because they are welcome here.
Yeah,
obviously.
I think they're familiar with it. How many of them are gonna give up what's going on in their daily life to come listen to the banter here when they know, the ones that are interested know they can get it online too.
Okay. Yeah.
So, it's 6 of 1.
You know what, I think I'd like to hear how you feel about it, Tom, because.
I serve at the will of this committee. If you guys want me to drive to the admin building, so be it.
Okay, I would prefer to be at the administration building. It gives us another chance to check our mail out there and connect with anyone else we need to connect.
Well, I just was asking. And really about a public safety issue about, because I have a compromised immune system and I know someone here had COVID, I would not have come into the building at all. And so.
That can happen anywhere.
Pardon?
These days, that can happen
No,
anywhere.
it is more, but I knew about it,
This is
Terry.
probably one of the safest places in the county.
I would not
as far as
agree with that,
goes.
but I'm just saying from my perspective, so.
Hi, Donna.
Okay,
It is something to consider. 33% of deaths in a pandemic happen in congregate living. So
What if we did a couple meetings a year here and the rest of them over at the admin building?
that would be perfect.
And then at least then you're still getting the opportunity that if the residents do want to come forward, they have the opportunity. I mean, you're here already multiple times a month, so it's not like you don't have access to the staff and the residents.
Right.
If there was a concern.
Right, and none of the staff or residents come and talk to me while I'm here. So,
I think that would be perfect to do it that way, and then you and Teresa could talk about which two we would have here.
It's fine by me. Like I said, I serve at the will of the committee. You guys tell me when and where and I'll be there.
I'm kind of cool with right here. It's not a bad deal, and it gets us out of the admin where we're cooped up in there all day.
so,
When we finally get to our projects and different things over here, it'd be nice to be over here to look at those ones.
I really respect your time and your proximity to being here. This isn't a type of job where you're just an administrator that, like, there's nothing anything can happen here at any minute, and the closer you are here, the better for all of us.
The only thing I'll push back on that is I got Tara here, who's my assistant administrator, and she's phenomenal, and I feel 100% confident that no matter what comes, she can handle it. Not saying that I want to push back, but I want to give Tara props where it's deserved. She can run this building without me.
Yeah, and if you didn't have that, that would be a problem.
I wouldn't sleep at night.
That's right.
Oh, that's great.
Well, thank you for the conversation. I appreciate it.
All right. Other member comments? Okay, well then I am interested in moving our discussion item 8.1, which is the investments strategy and the investments we have, move to immediately now after members' comment in the interest of Donna Kurtz's time.
I'd move to reorganize that, move that to one.
Second.
All right, all in favor?
Aye.
Aye. All right, so we will be discussing between 8.1 now, Valley High investments and investment strategies. Donna and Scott.
Our County Treasurer Donna Kurtz is on the line. Donna, I am ready with your presentation, so you're on.
Okay, great. Well, I want to thank Chairman for allowing me to do this remotely, and Scott and Tom for your help in preparing this presentation. I want to make sure, first off, can everyone hear me?
Yep.
Yes.
Yepper.
Okay, great. And I also want to ask that as questions are asked, can those be directed to Scott to ensure that I am hearing the question appropriately? That's okay with everyone?
Yes.
Sure.
Okay, fantastic. All right. Well, let's start with the agenda. So let's, first get past that first slide regarding the investment overview for Valley Operating Board. And again, very pleased to be here with you. So moving to the agenda, I want to make sure that you understand the playing field that we're dealing with. So we want to talk briefly about the economic challenges and opportunities that we face and how we are structuring investments accordingly. Secondly, we want to look at the Valley High investment strategies. The reason is I want you to have a high comfort level in the approach that we are taking, which is very structured and very thoughtful in its approach. Then we will actually look at how investments are performing and how we deal with the cash flow situation, because that is a very big aspect of being successful. It's not just making money for you, but it's also making sure you have the cash on hand when you need it. And then finally, we want to look at potential investment funds that could be available for additional investment. One of the aspects of what we are providing in the Treasurer's Office is a way to be sustainable for Valley High, or at least to be as sustainable as long as possible without taxpayer funds being used or minimizing those funds. And then, of course, any further discussion or questions, though certainly I welcome questions during this entire presentation. With that, I'm going to move to the next slide. Does that sound okay?
Please.
Yes.
Right?
Do we need to shift that table a little closer,
first
Scott?
off, what we're looking at is the Treasury yield curve. And though I know it's a little nerdy, I think it's important to point out what this yield curve is showing us is how the spike of the highest interest rates are more on the short end of the duration than the long. So what does that mean? That you're going to get higher rates the shorter that you invest. And that, for any of us who have ever taken out loans, it just doesn't make sense. Typically, can always go back to these concepts, but we'll talk about the inverted yield curve further in a few minutes. Okay, so looking at the trend, what we see per the market futures, and markets tend to be very accurate. Why? Because you've got a lot of experts understanding where Fed funds are going. Fed funds are the foundation for the interest rates that we end up having to work with, either for a borrowing or lending situation. Of course, we're lenders, right? We are out there to buy securities to generate income. So the Fed funds futures look like we are in a declining interest rate. And that is something we absolutely have to pay attention to if we are to maximize and optimize returns for Valley High. If there's no other questions, we'll move on to the next slide.
Yes.
Are you with me, Scott? Economic cycles?
Yes, we are.
Okay, fantastic. So I want to point out the economic cycles slide because this, I feel, is very important for the board to be informed of. And what this slide indicates, historically speaking, is that as we have rates declining, we have also experienced recessionary periods. And it is important to point that out to you, given your stewardship of Valley High and the need for cash potentially in an environment where potentially you've got less cash. You've got less cash available. Why? Because you have tax revenues that are also declining. So given that, that all feeds into our cycle of how do we invest and invest appropriately. So if there's no other questions, we're going to move now into Valley High investment strategies. Does that sound okay?
Yes.
Right? Okay. All right. Let's look at our investment strategies. First up, we are investing only in AAA rated investments. What that means is that when the bonds that we are purchasing, when they mature, you, me, the taxpayer, is going to receive 100% of the principal at maturity. That is something, obviously, when we invest in the stock market, for example, we cannot make that guarantee. And as your steward of our public funds, that is a very high level of priority for me as well. By the way, the AAA rated investments, these are things such as agencies, things like small business administration, Fannie Mae's, Ginnie Mae's, etc. And also FDIC CDs, which I'll show you some of our latest inventory purchases shortly. Second is we're not paying full price for our bonds. And that also puts us in a very attractive place because as declining interest occurs, and that is what we are anticipating given the futures that we're seeing, that increases the value of the face of those bonds. What does that mean? We've got an asset that potentially appreciates. So that's another nice hedge that we potentially have. Next is duration. And the maturity date is based on the Valley High cash on hand requirements. So as you know, Scott has worked very hard with Tom to put together an extremely sophisticated cash projection and cash requirement model. That has been what has driven the approach we are doing in the investments that we are making for Valley High. Last two things, investments being, we're only buying CDs at $250,000 increments per a bank. So there's a bit of research that goes into what CDs we're going to buy. Okay, any questions? If there are, I certainly understand. There's a lot of stuff that I've thrown at you, but it belies the level of sophistication, basically, that we're taking on as we appropriately invest these funds.
Donna, can you hear me?
Yes, I can.
It's Terry. So I've got a question. So in 2008, the bank failures were 94 billion, and year to date we're already at 110 billion. And I noticed that you've got interest rates dropping in this model by August. Do you think that maybe we would actually get off with only 3 bank failures? I know this is a bit like an institutional failure, but nonetheless, I mean, I was grateful to see the interest revenue and how it impacted the P&L
Yeah.
on our report. So,
Yeah.
so
Yeah.
I'd love. I mean, things are going to be bad. We're going to be in a recession. I'd love to see the interest rate. Do you see any of those factors that could still be moving parts?
Yeah, bank failures and private industry are a significant concern, but not given our investment strategy. It is a concern in another part of the treasurer's office and our business, and I don't want to take away time from today, but I will be speaking on this when I come before the committee of the whole.
Okay.
And so, Terry, I could not agree with you more. It is a significant concern, and I have taken some pretty dramatic steps to protect our tax dollars from any issues with private bank failures.
Oh, okay. And to clarify,
Yeah.
to clarify too, I wasn't concerned about the stability of the investments. I was just looking at the forecasted interest rates dropping and thinking that they might stay higher. I know this is a very conservative model. Do you agree it's a very conservative model on the forecast of the interest rates?
Yeah, I mean, given I would say the significant amount of evidence, time that I know personally I spent listening to the talking heads and what I read, I think that a recession could occur, and that will impact interest rates, and that I think would lower them. And well, you've also got some inflation issues.
Yeah.
Again, so I think we're trending downward with our interest rates. But hey, here's the important point of all of it. Opinions aside, we need to eliminate the risk and the unknowns by locking into the rates that we want to drive home for Valley High. And that's really a huge issue. Am I answering your question?
Yes. Yes, you are.
Okay, great. Thank you, though. Thank you for the excellent question. Are there other questions?
No, I think we're ready for your next slide.
All right.
Okay, terrific. Okay, so let's go to the next slide. This is slide 7, and this is Valley High Investment and Income Portfolio. And so what I wanted to do is I wanted to give you a sense of what is the money that you're stewards of. What is that money doing for us in terms of generating real, live dollars? And so you see the investment returns with the Bank of Oklahoma, and you see also the interest earned from Associated Bank. I want to point out the BOC, or the investment element, so that's the 2 columns over, you don't see as high of a return. The reason is we've had investments made in that account over the last 3 to 4 years. So we've got some historic, we've got history in terms of interest rates that are lower than they are now. So those averages have brought us, they haven't brought us down, but we're not achieving the higher interest rates that we are with, say, Associated. And I want to talk about that in a second, but the key here is that we are generating some very significant income. Associated Bank at this time is paying us 4.6%. So we're seeing some really good returns. Let's go to the next slide. And, I see I have a double. So go past that slide. And let's go to 9, which is Valley High Income Summary and Projection. Okay?
We are there.
Are we there?
Yes.
There.
Okay. And so what I wanted to point out here is that when we combine both the associated and the BAC income, we're seeing some very significant returns. And in fact, just over the last 5 months, we see about $400,000 in return of the overall funds we have available. And this is in a situation where we haven't, we have not locked in with longer term investments, but at the same time, we're really doing some nice work here with returns. And by the way, this is all about the economy. Yeah, we're being smart, but we are also fortunate to have these interest rates. So it's a good situation at the moment. Want to point out the projection then is what we're looking at based on what we have as of April 30th. We're seeing about, close to $79,000 a month being generated. And when we project that out, we're looking at just under $1 million being generated. Okay, let me now, before we go to the next one, what I want to tell you is that this fairy tale of all the money we're making is not going to last. And in order to perpetuate this as long as we can, we need to lock into investments, longer-term investments. The BAC investments we're making are going to take us out over anywhere from a year and a half to 3 or even 5 years. And so I want to make sure that everyone understands that the whole idea behind investing, as opposed to the money market essentially that we're receiving, that is short-term stuff. That fluctuates. For example, tomorrow the Fed is meeting. They may raise the interest rate a quarter point. They may keep it flat. They could lower it. But what we're dealing with is, a non-commitment. We don't want non-commitments. We want to have some guaranteed cash flow. So that is why we are making some very good investments for Valley High, and I want to point them out. Scott, if you're good, I'm ready to go to the next slide. And this is number 10, Valley High Investments 2023.
We can move on. I just want to reemphasize the point. When you saw the beginning slides, the inverted yield curve, that was cash. And then 2 slides back, the associated balance, that basically is cash. And you can see the interest earned because of the inverted yield curve. Cash over the past few months has been generating tremendous interest. Was it prior to that? And what Don is saying is it's not going to continue. We just hit a bubble. Unfortunately, we had a lot of cash in the bank with that bubble. But you're going to see that, and the market is indicating that's going to change. So this income, if we stay status quo, it's not likely you're going to continue to see $85,000, a month in interest, because all that cash, which is generating 4.6% now, is going to start dropping. And So the point that what we want to do now is, Donna will tell you about how we want to pivot from that cash to investment. So, Donna, I'm now to Valley High Investments, 2023.
Okay, great. Thank you, Scott, and thank you very much for emphasizing that point, which cannot be understated. You get no guarantees, and you miss out on high interest rates that we are currently experiencing. And this is our opportunity to lock into those rates. So you see that in the investments made over 2023. And I've been working with Tom and with Scott to ensure their comfort level in making not the specific investment, but rather the amount of the investment. And as you can see, we have, if you look at the yields that we have locked into, upwards of 6.32 are some of the higher ends, whereas right now some of the lower yields, more like at a 4.41 yield. So these are the kind of interest rates that you look at a year from now, and you won't wish you had. You will have them for a period of years. And we think we've got some other buying opportunities as well to buttress this. Does anyone have any questions regarding this chart? I'm not doing additional detail unless you have questions, which I'd be happy to answer.
Is it 3.5 or 2.5 at the bottom?
Okay, great. Yeah, and you do see that we have the
3.5.
bonds,
That's what I thought.
the CDs, et cetera. So, okay,
So
great.
Donna,
All right.
Oh, Jim
Donna,
Kearns has a question.
this is Jim Kearns. On all of these bonds, and I know you said everything is secure, all of these places where you're investing the funds, are they all secure with federal funding, insurance, and,
Yeah.
or do we have
Yep.
any that are
Okay.
risky? If the economy really tanks, do we have any that we risk losing our entire investment?
Yes, yeah, these are not, these are backed by the federal government. And so the bond that we buy, we are guaranteed the return of principal per the maturity date. So
For the total
base
amount of
value
each,
excuse me?
for the total amount of each investment?
Yes.
Okay.
That is correct. That is correct. So the face value is what we will receive. And the par value you see here on the far left, that is at a minimum the amount we would receive at maturity. And if we were to choose to sell those bonds sooner, potentially in a which we might consider if we had an interest rate environment that was decreasing. So if those bonds were to increase in their face value, we might consider selling them sooner and taking a profit there. But otherwise, we would not. So we won't get anything less than the face value of those bonds. The plan to hold them to maturity is part of that.
Thank you.
Yeah, thank you, Jim. Okay, so now we can move on to slide 11. And the purpose of me showing you this slide, I know a lot of you are like me. You're always looking at the concerns and the risk management. And so I wanted to point this out to you because this slide shows you the annual cash flows that are coming off of these investments. And not only that, but we also identify the specific types of investments that are currently in the portfolio. Why is this important? Because you need cash. You know, government entities need cash to, move forward with various projects for example, the memory care unit. And so consequently, the cash flow is very important. However, if cash is available and not needed for operating costs or projects, then we'll be able to plan ahead in making investments for that cash flow. And so, again, we're being very strategic in our ability to manage this investment. Are there any questions concerning that slide? Okay. I don't really want to spend any time on the next slide other than to say that the first slide is the nice graphic. The second slide is the specific numbers in thousands that we actually see cash flow coming off of our various investment types. So again, this is not smoke and mirrors. This is just right down to what is needed to manage this investment in terms of dollars and cents. I do want to point out these two slides are updated every month, and so this is based on March. I will have those updates. Typically, I get those about 5 days after the end of the previous month. So, okay, now we're on slide 12 or 13, whichever you want to call it. And this is decisions from Valley High Operating Board. So one of the things that Scott and Tom and I feel very strongly is it's important that we collaborate. We're working with all key parties. Certainly you are very key parties as a board. So I wanted to let you know that we had talked about what we asked the board for guidance on. And the question was, what should be the amount of money that should be in reserve at all times, thus making that commitment and then freeing up the available funds for investment so that we can lock into, at this point, what we're seeing, historic high interest rates. Would you, Scott, like to perhaps elaborate on that in any way?
Certainly, if you recall the model, and I don't know if I can maybe kick over real quick, there was 3 bands to the model. There was the capital indemnity reserve of $2.5 million. There was the band for 12 months of operating revenue, and then there was the remaining unreserved fund balance. And then you have this bucket. It's over $20 million today, and depending on the decision you make, that can ebb and flow. That is, we call it unreserved fund balance. Now, half of that right now is being invested. The other half is sitting in cash. One of the things that we are asking the operating board to do is to give us some guidance or concurrence to identify how much we should keep in cash, because right now it's about $13 million. How much should be in cash, and how much should be available to invest. And this is important because based on the premise that right now cash is doing pretty good, but that's not going to be the case in the very near future, as Donna pointed out. So on that representation that cash will not continue to hold our interest rates, the recommendation is take the money that we have in unreserved fund balance as much as you can and leverage that so you can lock in your interest rates and generate revenue for the next several years based on what you have. So basically leveraging that unreserved fund balance. Now really that critical question is how much cash, just adult cash, does Tom need access to run this facility? And then we'll get into another chart, but I'll give you a spoiler alert. Looking at everything, 6 months of operating. And we'll show you a graph after Donna's done with her presentation that shows you a 6-month operating, which equates to upwards around $6 to $7 million, depending on. So you're not talking a little bit of $6 to $7 million of cash, thereby leaving the remainder, which is more than $13 million today, available for investment. And then we have another analysis that shows the timing of those investments, because if you are going to support that recommendation, Donna needs to know how much she can invest for what period of time, knowing that we have some critical needs coming up. We need 4 million or whatever the number is for the memory care unit. But, so we can invest some of that cash, but not for a long period of time, because we're gonna need access to it to build the memory care unit. We know that we have other needs that are coming down. We have chargebacks that, the Valley High has to pay to risk management and to the county board for the services it receives. That could be a short-term investment over the years. And if you remember on that chart, when we get to the model, that line was kind of going down until you hit that sweet spot of what the optimum reserve should be. You're going to be burning down cash based on everything as it said, unless you make some changes to the variables that generate revenue for Valley High. As you burn down the cash, that means Tom needs access to that cash to pay the bills and to run and make budget year after year. And we're talking over to 2027. And when I pull the model up, it'll become more clear. So all that, once again, all those variables go into the mix. And what we want to do is present to you what that would look like, and ultimately ask for your support, your concurrence to adopt that investment strategy, so then Donna can take advantage of the market as we see it, and benefit from these interest rates, benefit from what she can lock in on a short and long-term basis, and have a revenue stream for the next several years out for Valley High, all for the sustainability. Donna, do you want me to switch over to my model, or do you want to?
Yeah. I have a question
Sure.
before you move forward. We're
Yeah,
talking about
I
right
think,
now.
I mean, I think that we've identified a interest rate environment that provides a huge opportunity for locking in high interest rates. We have a situation of cash flow that has been identified as a core in addition to the project requirements. And so basically, we want your buy-in to proceed with remaining funds to be invested into appropriate securities, which I've identified, and provide appropriate duration so that our cash flow is readily available to move Valley High forward, but almost as importantly, to generate funds to minimize the cost of Valley High to the taxpayer.
Okay, Gloria Van Hoff has a question.
Yes, so you mentioned that there were 12 months of operating reserves prior?
In the
to
model,
this?
shown in the model as in the optimum level of reserve that you want to keep.
Okay, so I'm unclear on something. What is our policy right now? How much do you have right now in operating funds reserved for that?
For Valley High, it exceeds 12 months of operating,
Okay,
and the 2.5 million capital indemnity reserve, so you were above that.
okay,
today
so
as we said.
we're above 12
Yes.
months right now.
Yep.
So we definitely don't need that, right?
No, because just a little bit of a historical background. The reason we set it as an operating board years and years ago at 12 months is because the state of Illinois, and you know this, was 6 months and 9 months behind on Medicaid
That's
payments.
right, yeah.
And so we said that we would keep a year's worth because we didn't think they'd ever go past 6 till they went to 9, so we were hedging that bet. Now that we are under the managed care program, we're getting paid very regularly. So moving to a 6-month fund window, and we've spent, Scott and Donna and I have spent hours going through what all the scenarios could be. 6 months is where we're comfortable with. That leaves us with enough money for payroll, supplies, and anything that would happen. And then the way that the treasurer's got it set up, money is rolling off every month, so you're replenishing that. And each month then you have a decision. Do you reinvest it? Do you pull? And that's what she'll be working on based on the strategy. But we're looking for a blessing to reduce that from 12 months down to 6.
And so, just to be clear, so this is the model. This is 2.5 million of capital and indemnity reserve. This is the 12 months of operating based on the model and all the assumptions and costs that we expect. The intent of this model is to show you where that sweet spot is, where you can have the 2.5 million plus 12 million, and it'll give you an idea of what you need to do, whether it's, through taxation, bed mix,
Scott,
different
are there
variables,
questions
to
I
keep
can
this line
answer?
to where it needs to be.
Right now, Scott is
Scott's got
talking
it.
to us about our
The
model.
model. But that's,
Oh, good,
yeah.
good. Thank you, sorry.
and
Perfect.
that's just reserve. That doesn't indicate cash versus investments. That's the combination of both in there. Now, what we're looking to do is dissect this a little bit further and say, okay, how much cash do we need versus how much should be invested, and so then we develop based on the model, we developed a chart, and this, let me if I can get a little bit further. This takes the data from the model and looks over the 5-year, gives a 5-year outlook and says, okay, how much cash do we need based on the 6-month, and how much is available for investment, and at what duration? And so, on the very high level, can everybody see the numbers?
It's kind of hard to see the numbers.
So,
Yeah.
let me zoom in just a little bit, and okay, we'll zoom in. And so this is intended to be a tool that under that investment approach that Donna and her team can use to understand how much you can invest and for how long. So this, the blue number up top, the ending fund balance, that correlates to the total amount of unreserved fund balance, or the fund balance that you have. Okay, so we talked about a 6-month operating cash, anywhere from 5.6 million in 2023 to 7 million in 2027. And that's what we're saying will just remain cash, not invested. And now we'll give the cushion to allow Tom to absorb cash shortfalls if Medicaid is not paying, so on and so forth. And just to give you the county's policy is 5 months of an operating reserve, so for general fund. So this is still a little bit higher, but it's an enterprise fund, and so you want to be higher. So that leaves an investment potential, and I'm just going to focus on 2023, even though we're halfway through it, but this thing, of almost $17.9 million of potential to invest. Under the approach would be keep the cash and then try to invest that $17.9 million. We know that each year there's going to be a chargeback to Valley High for all the costs for risk management, their insurance policies and claims, and that happens every year. Plus, the county has a $500,000 chargeback for the administrative costs, HR, IT, a lot of the support services that go into this facility. And that's built into this current budget year, and the plan is that in subsequent budget years it'll be similar. That's called a chargeback. The total of that is over $800,000, but because that's a 1-year outlook, we're going to just do it in 1-year increments. We know that we collect it after the year closes, so in a 1-year chunk we'll reserve that. Donna can invest it for 1 year, and then we'll claim it, and then we have another chargeback built into the budget, built into the model, which she'll invest for 1 year and just keep that process going. But it compartmentalizes your chargeback. And then we have what we're going to call the core portfolio. The core portfolio is how much can we invest for a 5-year period? Because with investments, and when you get into the right investment tool, the longer it is, the more yield that you have for potential. And so that capital and indemnity reserve of $2.5 million, that's just in case. We've not had to touch it, and that's just a comfort band. Know that if something major happens, we have the ability to absorb it. Now, if that something major happens, it's not going to be overnight. If there's major lawsuits or something, we're going to see it ahead of time and be able to pull that back. So I want you to be comfortable on that. But we have that money reserved. But $2.5 million for that 5-year period, plus, based on all the other needs, what else can we invest for a 5-year period? So what we did under this scenario is we took, I call it the low water mark. For any year, based on, if you remember that the line going down, at, 2027 to low water mark. So what's the maximum amount in 2027, our lowest year, that we can invest, and that becomes the base for our core portfolio for 5 years. And then that same methodology was applied for each year to come up with a 4-year investment low water mark, a 3-year, a 2-year, and then a 1-year. Now the 1 year is significant because it's 5.2 million. And we know that in that 1 year, we're gonna start building that memory care unit. So we're not gonna need 4 million or whatever from day one on that project. It's gonna be about a 1.5-year project, and those bills are gonna be, coming in over time. So rather than sitting on that cash, we're gonna come up and we're gonna further define the cash flow for that project, and that offers a short-term investment opportunity, once again, that Donna can take and find maybe a good instrument, because we don't have to, pay $1.5 million to 2024, then we can invest it. We're gonna need that cash at some point in time, and then she'll find an investment that matches that need. And so that's why you see that 5 million, and that's really the big drop between 2023 and 2024, is it's taking out that memory care unit. So under the philosophy of leveraging what we have beyond the 6-month operating reserve, this will guide the investment duration and approach. And it's all teed off the model. So, and that's what we have to present for you today.
I have one more question. I heard you mention something about staggered, I don't think you used that word, but that's what
The ladder?
maturity dates.
Yeah.
So are they coming like every year or every 6 months that they are maturing? Just if you could give me a little
No,
more.
actually, I'll turn it over. Donna, are you still with us?
Oh, yeah,
Yeah.
absolutely.
Gloria is asking about the staggering of maturity dates or the laddering approach. I was wondering if you could touch on that.
Yes, absolutely. Gloria, very good question. And absolutely, we are laddering our investments. As you saw with the investments that we have been making, you see various durations for those investments. They are based on 2 things. One is, when is cash needed? And secondly, how can we ensure we've got diversity in having investments come due? And the reason for that is we're also managing what I'm sure you're familiar with, being on a pension board, and that is the risk of rate increases. So you want to try and diversify so you can minimize that risk.
Okay, thank you, Donna and Scott.
Sure. Yeah, and we can always show you more detailed reports to show you our approach with laddering at any point. Just give me a heads up.
Okay, thank you.
I just want to add too, we're presenting to you an investment concept and approach. As we know, things change, right? And so I think part of this is, once you get rolling, it would be a commitment of Donna and her team, myself, Tom, to periodically review this. And part of that is just to ensure that we know when we need cash, we're going to have investments come due to ensure that that cash is going to be there. So at no time does it put the operations in jeopardy. So that oncurring regular review, I think, is critical to this, just so we know. Or if something major happens and we see a need, we can plan for investments to, when they come due, to not being reinvested. So we can always adjust in the fly. Based on that laddering approach, it gives you that agility to do that and to anticipate cash needs and maybe not make the investment that we otherwise would if that cash is needed.
Okay, and that was my concern.
Yeah.
If we need cash, how liquid will it be?
Well, you're not gonna drop below that 6.5-ish million. It's still liquid in the bank.
Okay.
I mean, that right there alone, you're gonna cover a boatload of payrolls and your supplies for a period of time. So there's a very good comfort level with the 6-month mark.
Okay.
And the way that she's got it laid out, some of the maturities happen at key moments where decisions need to be made.
Okay.
So it's been really well thought out. I can assure you there's a lot of time that's been put into making sure that every maturity hits a mark and we know where we can go with it.
Okay. Very impressive.
I do have a question. Donna, are there other enterprise funds the county has that we're doing a similar strategy with?
That's got a little garbled. Can either you move closer?
Or I
to
think
the
Scott's
microphone or
Scott
have
repeated.
Yeah.
I'll repeat the question. Teresa was asking, are there other enterprise funds in the county that we're taking a similar approach on?
Oh, I love that question. Thank you, Teresa. I will pay you later.
I will pay you later.
We are currently taking a very similar approach with ARPA and generating some significant funds there. As you all know, we need to have ARPA funds available in liquid form November of 2026. So as a result, we are taking a very, very similar approach. I do want to remind everyone that the model that Scott and Tom have worked on, and Scott's really been a champion on, is based on so many sophisticated variables in terms of income flow. So the reason I bring that up is because ARPA is relatively simple. It's a date certain, and we're done. And at the same time, Valley High, it's like changing a tire on a moving vehicle. There's a lot more sophistication to it, and I feel we're addressing that with the model, with the close communications, and with the investment opportunities that we have before us.
Jim had a question.
Jim did have a question, yeah?
I did have a question.
One other, let me take one more swag at that very good question, Teresa, and that is, we are talking right now with transportation. McDOT may have some available funds as well. They will present a little bit more challenging cash flow, not insurmountable by any means, but certainly there's an opportunity in working with them. And then the general fund tends to be more of a standard revolving fund investment. But again, we are absolutely taking similar approaches, but we are tailoring it to the needs of the specific departments/institutions that we're working with.
Jim Kearns, you want to answer your question?
I just want to clarify in my brain, it's kind of mush, so I'm not sure if I'm looking at this correctly. So your associated balances are cash revenue. In the month of April, you had just shy of $11 million in that fund. In the month of April, you earned $54,000 in interest. Right? If I'm looking at the Valley High investment income portfolio, and in the
Sure.
BOK,
Jim, are you talking to me?
yes,
Are you talking to me, Jim?
Yes,
okay.
I am.
Yeah, okay. Thank you.
there's a movie like that,
Are you talking to me? Take this time.
On the Valley High investment income portfolio chart, the one from December to April, of 22 to 23 in April. The bottom line, just so I understand what I'm looking at here, most definitely, is the associated balance was just shy of $11 million in April. And that earned interest of $53,951, correct? In
Yeah,
the Bach
that's correct.
investment principal balance was $15,363,000, which was a little bit of a movement because it looks like you already shifted those funds to the Bach, right?
Yeah.
Some
from
have,
March?
Yes.
So some have already shifted.
Is that the correct slide?
That's the correct chart.
This is the Valley High Investment in Income Portfolio, slide number 8.
Yeah.
So,
Okay.
so with the
Help me
15
with
million,
what is your question?
my question is with the $15,363,000 investment, that generated $31,522 in interest in return, investment return.
Yeah.
And
Okay.
the $11 million, $10,927,000 generated $53,951, $54,000.
Yeah,
So-
Jim, let me go back to that question. I I anticipated that question earlier. I answered that question earlier, but I am glad you brought it up again because it allows me to emphasize the situation that we currently have and the ever-changing interest rate environment that we are moving towards. So right now, the associated bank balance, which is in cash essentially, is getting a rate that was at 8, it was at somewhere around 5%, right around 5%. Why? Because of the fluctuation of interest rates in a money market. It has gone down for a couple of reasons. It is now at 4.65. So we will see a 4.65 rate this month. So the month of May. Now, with Bach, we have made a number of investments. However, we had an existing portfolio that had bonds in it from, anywhere from a year to 2, 3, maybe even 4 years ago. And many of the interest rates of those particular bonds were not anywhere near the interest rates we're seeing today.
Okay,
So while
stop right there.
so when you average it out, you see that the effective rate with Bach is less, but that is changing as we are having cash roll off and then reinvesting it.
Okay, right there at that last point there where I was trying to stop you, that's my point of questioning. That rate that Bach is currently paying is around what, and those investments in average? Because we know that long-term interest wasn't paying anything per se, a year and a half ago. And it's been creeping up and exploding this year, I agree. So my question is right now our interest rates in the cash bank are around 4.6%. What is the return on investment of the ones you're renewing into the Bach? What is that return? Not the average.
And yes, so if we were to take the interest rate that I provided earlier, let's see, and certainly, really a very, very appropriate question, though it is a difficult one to answer because we are constantly having money coming off and then reinvesting it. So if we were to go to slide, I believe it's 10, you see on slide 10 where we talk about investments made in 2023, which I think is actually an excellent way to depict the yields for experience. You can see going down column number 4, you see the yield varying from a 4.4 rate upwards of a 6.32 rate. Those are the ranges that we're dealing with and the potential return that we may get with any given investment. We have some investments, I happen to know, having worked with the broker as of today, where we may see some rates upwards of 7%. I don't know if they'll be appropriate for Valley High, but we do see some bond opportunities in those categories. So that's what we're working with. We have some very specialized opportunities that have come up because of frankly, bank failures and the need to liquidate their existing portfolios.
So these are all recent investments from February through April.
So if you look to the left at the numbers, that's why you see that drop over those couple months, because that money's moving from one side to the other side of the investment portfolio.
So right now, you're expecting new bonds to come out around 6 and 7%, new investments. And I'm saying that wrong.
And whether those investments are appropriate for Valley High given specific requirements, we don't know. And I will tell you these, very, very high rates are unique because of some specific economic conditions that, believe me, will be very short-lived. And that's what I'm talking about, these bank failures. You read about them in the news, Silicon Valley, and Signature. It's creating an inventory at a discounted rate. Very unique situation.
Did we have any investments in those? 3?
We are buying bonds out of that inventory. We're not buying those. Those banks are out. They've been
Right, so like Chase bought out the,
essentially put on business. The FDIC, Federal Depository, FDIC, they are selling the bonds. They're all government bonds. This is all, again, the investments are the same. They are AAA rated investments. And these were AAA investments held by those banks. Now that these banks are basically bankrupt and put out of business by FDIC is coming in and liquidating these opportunities for bond purchases, of which we happen to be potentially one of those customers. But again, it's all federal government securities. This is not private industry at all.
okay, no, you kind of explained, that kind of answers my question, where those higher rates are coming
Yeah.
from. Okay.
Right, no, great question, very, very appropriate question, for sure.
So today you want direction from the committee as to how much we should take from our reserves? That's a today question?
Yes, if you're comfortable with
Yeah,
our recommendation to move it to 6 months and invest the rest.
Someone
Right,
needs to make
well-
a motion, right?
And talk to me in dollars again, 6 months is how many millions?
It's gonna be roughly between 6 and 7-ish in today's dollars. Obviously, next year it'll be more, then a little bit more.
Leaving you about another 4 million, what you currently have to invest in Bach. Because you're about 10 million right now in
Yeah.
cash.
I think that sounds right.
So you're looking for about 4 million to move over.
Yes.
I can live with that myself.
Well, so when we look at our how much money we have, it's like $23 million. That's in Billy High's.
Should be 26, here's
Oh,
something.
yes. Well,
Add
back.
them together.
There it is.
You got it?
Usually it's at the back of your report how much money Billy High has.
Right
There it is. Yes.
Can we
26
make a
million.
motion, may I suggest, and a second, and then have some discussion?
Sure. All right, who would like to make a motion?
I will make that motion.
All right, we're gonna make a motion
Wait,
for
wait.
discussion.
John?
A motion for this, can we make this motion, or
We can
we're just giving
discuss.
advisory?
We're just giving
We're not voting on
Yeah, we're
it.
just-
Yeah.
Okay.
We're looking for
So
consensus. We don't need to make a
But we
motion.
need to be on board, is that you're
We,
asking for?
we want your blessing. Just,
Okay.
Yes.
So
yes, we're
a
comfortable
holy
with this,
water.
or no, we are not.
Sprinkle, okay, so then we
Alright.
don't need to.
So the $26 million, we're currently investing 13 million of it?
Right now, currently, at the end of April, you've got
15 million
15.3 invested on the box side.
Right.
And you have about 11 million sitting
In a bank.
in the bank,
So we wanna take 4 million out of here and add it to the investments.
roughly,
Yeah.
sliding it across.
All right, so any discussion about concerns about that?
No, I have no experience in this area, so if.
So that was a master class then,
Oh, you
right?
mean you didn't move 5
I-
million
I
this
don't-
morning before you
It's always
came?
easy to move
Anymore,
someone else's money.
Yes.
I don't, yeah.
Let me
No, no,
fight
no.
you on that.
If this is what you're recommending between you and Donna and Scott, you have collectively way more experience and knowledge about this than I do. So I would support what you want.
I mean, I think it makes sense to take advantage of what are otherwise negative economic conditions in our favor, so I have no objection. I think it's a good,
And I understand we would be taking advantage of a curve that's going on right now.
Yeah.
So, to do this sooner rather than later makes sense
Yep.
also.
Correct.
Well, they already did 5 million last month, without us knowing that, just so you understand that.
Right.
Sure,
yes.
take us down to
And now
that
they're
12-month
asking
mark.
For more.
Now they're asking for more, to make sure somebody doesn't flip the lid on them.
And Jim, keep in mind that, so 5 million added, but there's gonna be other coming off, down the road. So it's,
Understand. but we're gonna end up maintaining about 6 million permanently in the operating associated banks. And that just moves the other one up from 15 million to around, you're gonna take another 4, around 20.
Yeah.
Can you show us the model again, because we had big drops in other years. Right, so the issue is if we get hit by something hard.
Well, the first big drop though was the tax rebate.
Right.
Okay, so
Yes.
that's not something I would anticipate coming around again, at
No,
least
it's
not in my
not.
lifetime.
No,
The next big drop is when we did the therapy addition in the gym, so it's another one-time project.
How much was that? 3?
Yeah, somewhere in that range, yeah. So what's that, 3 point,
Yeah, just a little under 3.
yeah, 2.8.
And that also includes too, I think you were in the red for Valley High that year a little bit too.
that was COVID years, yeah.
Yep.
Then you have COVID. And then this drop, this anticipates the memory care unit. The model's contemplating, for 2023, this current fiscal year, about a 1.5 million need in cash, and then 2.5 million next year. As we indicated, so that 2.5 million, we know we have it allocated, but it won't be spent. And that gives you the opportunity to at least invest it for a short term, and then whenever we need it, we'll have it. And that's gonna be developed based on the bids and all the other information. Once we have the contract in place, we'll understand what those cash flow needs are.
But right now, today, as of April 30th, the Valley High funds total 26,290,000, according to your chart.
Right.
On that chart, show me the 26,290,000.
You're looking at different time periods. If you're looking at current, this is year to year.
Right? Oh, you don't move it ahead month to month?
No.
Okay.
No.
That's
Yeah,
right.
I mean,
We're up, right? We're above the 25
I say
million
take
in real
that
life,
challenge.
but it says that
No.
behind us.
I think Carl had a quick
Well, it's
comment.
like your QuickBooks, you do it that way.
Carl Kaminsky,
I don't know if it's for Tom or Scott, but you had, I wanted to know myself. You had talked that you had 12 months cash on reserve and you feel comfortable dropping it to 6, and I think that's what our question is, do we want to go down this? How many years did you look at that, I don't know how to phrase it. We had the 12 months, how many years did you look at it to say, 6 months looks like the sweet spot? Was it 1 year, 2 year, 10 year,
so
15?
It's actually multiple answers to the same question. So when we set this up, this is pre-COVID, this is back when the state was straight up fee-for-service Medicaid, meaning that there was only one payer, and that was the state of Illinois. And so what the state would do to long-term care is they would balance the state budget on the backs of the seniors. And so they wouldn't cut your rate, they would slow you down in the payment cycle. And so what they would do is they would catch you up, and then they would draw you out. And so all of a sudden it'd be 1 month you didn't get paid, then it would be 2 months, and it'd be 3 months, and then they would catch you up. And so we were hedging that bet. Just before COVID hit, Illinois moved to what is called Medicare and Medicaid alignment. And so that's managed care, the long and the short of it. Now you have multiple managed care companies, depending on who the resident is assigned with, that is making those payments. By state statute, those payments have to come in right away. So we are no longer dependent on waiting for the state of Illinois to pay us. So that situation has changed and has been consistent now for quite a few years.
Okay.
So we're at a point where we know unless all the managed care companies decided we're not doing business with Illinois anymore and pull out, and we go back to a traditional fee-for-service, we're good to go.
Do
Now,
we trust that the state won't turn around and screw up?
the truth of the matter is I don't trust anything with the state, but at the same time, my involvement at the state is I'm learning these things before they ever hit the ether, before it's ever out there, and that's when we get on the horn with Donna and say, hey, in 12 months, in 18 months, the state is going to go back to fee-for-service. We need to roll back off 6 additional months to put back into our liquid cash. So we would always have the ability to be flexible with that, the way she's got it laddered.
Okay.
And so we just stay, as long as we stay ahead of the curve with what's happening in the industry, 6 months is more than enough.
Okay, I'm happy with that.
Yeah.
Okay. Then, if there's no more discussion, that the committee members are in agreement that this is a good strategy?
Yeah.
A strategy we support? Alright. Alright, well then, we support this strategy.
Thank
She'll
you.
have that look
You
in
done
his
good,
eyes.
Donna.
Thank you, Donna.
No, I'm fine with
Donna,
it.
thank you.
Thank you.
Because we can, if we're in an emergency, we can pull those back.
So Scott, can you tell
And
me
you
what
can
the
always pull
final,
them at a penalty too if you ever
summary
were
of
in a terrible
decision
position.
was?
So it's not like we don't have access
The
to it.
committee
We
supports
just
this
want to
approach.
maximize it.
She answered my
Oh,
question,
good,
saying that
okay.
if
Well,
we-
100%.
Here, we don't lose the entire
Listen,
investment.
if you
That's
guys
my
invite
question.
me out again, I'll come out next
Should
month,
always be
and,
for all of us.
I just really appreciate
So I don't trust
the,
that.
really, concerned kind of questions, and also just the intelligence of the questions. It's really fun to be able to get in front of you guys and have these conversations, so thank you. And, Tom and Scott, I'll continue to work closely with you, and, I'm gonna actually call the broker right now, because there was something that he showed me earlier, and I was wanting to get it for you guys, but now I have approval, maybe we'll get it. All right, thank you, everybody.
Thank you.
Thank you, Donna.
Oh, take care. Bye, Carl. Bye, everybody. Thank you.
Bye, Donna. Alright, our next, piece is the Valley High Administrator Report. So we all had it emailed to us last night, we have it in front of us right now.
I
You don't have a
apologize for the
copy?
late copy last night.
Did you get one, did you get a paper copy, Lou?
No, I have it on my,
Okay.
Oh, perfect. I was just gonna send a paper copy your way.
no?
So, I'm actually probably as part of the report just gonna cover 7.1. I'm just gonna roll it all into one piece. So, I got a couple things that I wanna bring to your attention that are not in the report, just to put on your radar. These are not earth-shattering things, but, they're gonna come up. So, ARPA is one of them. We have one more ARPA payment that we are expecting. We should get it at the end of May, beginning of June. And what that's very specifically use money. And it's the last one that the state's giving for personnel. So there's a small percentage that we can use for COVID-related costs. And that's all, we eclipse that amount by tenfold. The remaining amount is supposed to go back to the staff, and that's part of that retention that the state was doing. So what I'm gonna be doing in June, probably the first payroll in June, is I'm gonna bonus out all the staff, the entire nut of the funds. Now, the way we've done this in the past, so this will be the second time that we've gotten ARPA money that is supposed to go to the staff. We're gonna use the exact same formulary. If you've been with us for, I think it's a year or more, you're at 100%. 6 months is like a smaller amount, but everybody, regardless of your position, gets an equal share. This is not hey, the administrator takes the big chunk and then the housekeeper takes the small chunk. No, it's just a flat number. Everybody gets the same based on their being here. It's a good amount of money that all the staff are gonna be getting as a bonus. So when we do this, obviously we'll put a letter together thanking them for all of their hard work over the last year and do all that. But the plan here, and hopefully not a lot of them listen to this thing, because I'm not telling them this. This is going to be a surprise. So the only people that know about it is a couple of the department heads. Some of them, the remaining ones, know there's something out there, but they don't know what the actual amount's gonna be and everything. But it's gonna be a nice check that goes on their June paycheck that everybody that's employed is gonna get. And like I said, it's equal share. I don't buy into this hierarchy BS. We're all pulling the same amount of rope. So expect that. When I will, obviously, you two will get the letter that goes out to the staff and the plan and how it lays out, because it worked great the first time, so we're just duplicating it the second time. So that's coming. The TV system replacement, May 22nd, the week of May 22nd, that goes into place. So the residents are picking the channels sometime this week so that we can get that lined up. I meant to get both of these into the administrator's report, and I just completely blanked last night when I was doing it. Last thing that's not in the administrator's report, we have hired an assistant director of nursing. We have been in the market for assistant director of nursing for quite a while. I am not a firm believer in the right now hire. I'm a firm believer in the right hire, which is why it has taken as long as it has. And we've got enough support amongst my leadership team that we would be able to weather that storm. We found a diamond in the rough. someone that's from our area, living in Wisconsin, moving back to be closer to home because they have kids, and is looking for their forever job. Young, full of energy, has every qualification you could possibly want. It's the perfect fit. And this is how I know it's the perfect fit. I try not to make decisions based on emotion, so we interviewed internal candidates. But it's really easy to get lost in an internal candidate from an emotional standpoint because you're already invested in them. So before we started, I took my leadership team of nurses, and I put them together, and I said, I want you to write down, what are you looking for? Not who are you looking for, but what. The candidate we selected checked 100% of the boxes on that form. So it made the decision real easy. And then it was just a matter of working the numbers. And so, well, now that I think about it, May 22nd, the same date as the TV system, is her start date. So she'll be coming on board with us there at that point. I think she's going to challenge our director of nursing in a good way. So between the two of them, I have big expectations before the end of the year. So we will keep you apprised as to that, but we're expecting our new ADON in May. I will make a formal announcement in a week. I just notified all the candidates that we've made a decision, so I want to let that rest for a few minutes. The internal candidate that we seriously considered is a young nurse, and I'm not talking chronologically in age. I mean, she's only been a nurse for 2 years, but she's got it. And, you just kind of see people that kind of have that leadership vibe that they put off. So we're not done with her yet. When I brought her in yesterday, I let her know that we were going to give the position to somebody else. However, her journey begins now. And so we have a part-time leadership position that we're opening up for MDS and Care Plan. So we're going to put her into that, and we're going to begin her training. And when Beth retires in 2 years, my Care Plan coordinator, I've already got my leader picked for that position. And then that's how a lot of ADONs and DONs start. They start at the Care Plan process, and they start working their way up. So when we left the meeting yesterday, I told her, I said, I know you're disappointed, because I know I could see you had your heart on it, but we're not done with you yet. Once you've been identified, and I let her know, once you've been identified as us in that track, you're in it forever. So, again, we covered another part-time position we have open, so what we're going to do is we're going to split her. So she'll stay as a floor nurse, but we're going to take 2 or 3 days a week where she doesn't work on the floor, she works in MDS, and then that way we have that flexibility, and we'll just continue to groom her and have her be ready for when Beth retires. That Beth's retirement is the one retirement that scares me the most. And I've had one MDS coordinator for 20 years. That's unheard of. I don't know anybody that's had one for longer than 3. I brought Beth with me when I came. To have her retire scares the you-know-what out of me. So if I can train somebody for 2 years to have the exact same approach, we'll be in great shape going forward. So that's our plan. And the new ADON is also positioned to be able to slide right in when Dawn retires in a couple years as well. So succession planning is a big deal, especially in long-term care. Continuity of operations has got to be considered at all times. And I think we in this process, we got 2 birds with 1 stone. So that's where we're at with that. Census-wise, we are blowing the doors off in referrals right now where we can't keep up with what's coming our way. And that's despite the fact that we did not get into the PAN. So the hospital notified us a couple weeks ago that they were not going to accept our application. My pride was hurt a little bit. I just feel like we're so much better than the facilities that are currently in the PAN, but that's okay, because it's not impacting operations in any way, and I just have to take my pride and stuff in the sack. Last month, we had 25 admissions. That's 5 more than our record any month prior. So it's kind of like we don't need the PAN in order to continue to stay viable.
Can you tell me what that stands for?
Post-acute network.
Okay.
So they've got 2 facilities in this post-acute network that they refer a lot of the hips and joints and some of the more rapid short-term rehab. In order for us to participate in that PAN, which we were willing to do, there was a lot of requirements and hoops that we would have to jump through with the hospital. Length of stay being one of them. They wanted us to take the length of stay that we have and shorten it, so people would not be here as long.
Yeah,
We don't need to get into all of that.
yeah.
But because we're not in the PAN, we're not beholden to that. So we get to continue to operate the way we've always operated. And look, if I'm running full, I don't need the hospital. And so we'll look at it again in March, because every year in March is when it opens. If we are continuing to be where we're at today as far as referrals and full, we're not even gonna bother, because the amount of time that my team put into preparing that presentation, unfortunately, I almost feel like it was just lip service so that we would stop emailing them and asking them if we can get into the pan. So, we're fine. We're better than fine. I mean, the phone's ringing off the hook. So, we'll make the best of that situation. We are at 84 residents in the building right now. Our goal is 80. We are using a little bit of that memory care unit that's slated to be used, or be taken out of service. So we're not gonna run at this level for too long, but right now, it's, take an opportunity to bring in the revenue, and that's what we're doing. So, the staff have finally settled into the new way of operating, and so things run a lot better than they did about 5-6 months ago. We've kind of hit that stride, and so we're in a good spot when it comes to census. We definitely could use more staff. Our agency expenses are going through the roof. It's kind of the double-edged sword, though. If we want to run at this level, we got to have the agency staff. As long as those numbers still work, you keep the census where you're at. When the numbers are no longer in your favor, you bring the census down, you bring the agency down, and you match that back up. You saw in your report the numbers for the first quarter. Obviously, Donna's plan has a lot to do with it, but we're in the black. It's the first time we've been in the black since pre-COVID for a quarter. So things are working well. We don't need the pan right now in order to be, solvent and successful. So we're just going to keep humming along, and I'll let you guys know in about February of next year kind of what we're thinking and where we're leaning. You'll probably know ahead of time because you sit in our QA meetings.
Yes, which is very, very important, I think. I think the QA meeting is probably
That's the big one
Yeah.
every
that's the
month.
big meeting, yes.
It's really big. Ours is QA and safety.
Yep, our safety is the week prior to it usually, and that one's about an hour. QA for us is a solid 3. Easily, that's why you get fed the nice lunch.
Good, that's why we get in this lunch.
Yeah, so that's kind of where we're at with census and staffing. We are going to do a pretty good recruitment push here once we hit spring and the kids come back from college and try to lock some of that staffing down. Even if we can tail off the agency for 3 months, just through the summer, that'll still be a huge benefit to the bottom line, and then we can figure out where we're at as we hit August and everybody starts heading back to school. Let's see, strategic planning. Our internal strategic plan, we've got all the way up to, on Friday morning, we are going to sit down and assign deadlines and responsibility. So at your June meeting, I will be giving you guys a copy of what our strategic plan is, and that's our operational, how we're going to keep your goals and your strategic plan in focus. So the two kind of go hand in hand, but my staff have to operate from a much lower level strategic plan than the one that the county does. So you guys will get a copy of that probably next week, because we'll get through the discussion. I'll send it out to you guys, and then we can talk about it at the next meeting. For the most part, you guys don't approve anything on there. It's more, I'm just letting you know what we're doing in order to align with all of your goals for me and what Pete's goals are for the facility. So that should be done next week. And then, let's see, memory care and survey. If you want me to just keep rolling.
Yeah, please. No
All right.
questions? Are
Yeah.
there any questions about the report?
Well, I just wanted to ask with the PAN, do you do that every year, apply for it then?
We've tried to get them to allow us to apply for years.
Okay.
They finally allowed us to do it this year. We are going to do it again next year.
Okay.
I mean, depending on where we're at. If we're sitting here where we're running in the black, the referrals are great, the facility's full, and you know what? Then the hospital can just deal with their 2 facilities. Because the truth of the matter is, I'm getting those residents on secondhand anyway.
That's right, you are.
I am. I mean, I'm not going to name the facility, but I have a pretty steady stream of residents on day like 5 or 6 coming from there to here, and we finish them out anyway, so we're good.
Well, it's a good process to go through. Anytime you go through those really heady application processes, they force you to look at policies and procedures and they just get you to look at what you do and to be able to say, we have a really good program and we don't need this is kind of cool. I mean, I think that,
I can't disagree with what you just said.
that sometimes freedom in your programming, especially in the medical field, is just so good.
Well, I will tell you, our medical director is not disappointed that we're not in the
And I bet.
In fact, Teresa will tell you, when we first started talking about, hey, the application phase is open, he's like, don't do it. Don't
Well,
do it.
yeah, well, that's a
Yeah.
whole nother
Too many
conversation.
hoops. And
Yeah.
once you get on there, or one side, you're there forever. So now, we're okay.
Good,
We're okay. We might even be better than okay without knowing it.
yeah.
So. All right, any other questions about the report?
Nope, move along.
All right,
Let's
great.
talk memory care.
Yes.
This is the exciting one. So what Tom Burrows and purchasing and I did is we pre-qualified all of the firms that would be bidding on the actual construction. So we have 3 firms that have been pre-qualified. This morning, we sent a 1,026-page bid to the 3 firms directly. They have, I think, until the last week of this month to get a bid in. And in June, at your June meeting, we will bring you a resolution to award a construction company. We are there. If you really want, and I mean, you just want some heavy reading, 1,026 pages, you let me know and I will forward that to you. But I am not printing that out.
Electronic only, of course.
Yes.
Absolutely.
Right, I went to open it today, and then I was, never mind, I'll do this on a
Her phone said
bigger
no.
computer. Yeah, my phone did say no.
The good news is we've pre-qualified these firms. Tom Burrows already is comfortable with them. The architect firm's comfortable with them. We're very comfortable with the drawings of the project. We're really now, it's just a matter of getting through the next hoops. So
And
next,
I don't feel like, I'll speak for myself, I don't need that kind of detail. You know, I know that there are so many eyes looking at that whole process from,
some people really like to look at architectural
Yeah.
drawings.
you know,
And looking at, how's it gonna flow and
I
everything.
don't mind the architectural drawing, I just don't want, the detail is not, I'm not, no.
I think that was the meeting I missed the drawings.
What, Jim?
I'll forward it to you. I'll forward you the bid document. They're all in the back, on the bottom of the bid
That
document.
was the meeting I had an emergency, I had called in.
Right, yes. I mean, I think we haven't, in this season, we have not gone into the detailed memory care that we did when we were deciding about memory care.
Oh, in the past.
Yes,
Past.
so
Okay.
you know more than the rest of you and I know more than the rest of the committee, because like, we did go into a lot of detail before this season of,
I'll send it out to the committee. And if you guys wanna look at it, great. And if you don't, that's okay too.
yes.
And you're not gonna hurt my feelings.
So we have to
So
delete.
that's not gonna, okay.
It's not new, you still know more than the rest of the committee.
No, I don't, guys.
So, and
I'm sleeping.
I would imagine that we get towards, so the June meeting, you guys are going to approve it. It's going to go before the county board in June. So let's just say we award it July 1. And a couple months to ramp up. We're looking to start here sometime at the end of the year, finish in '24, occupy in '25. Now, I'm not giving you hard month dates because
Of course not.
I learned from that project that it's not going to be even close to what we're proposing. So that's kind of the way it's going to timeline out. So in 2024, so next year, we will hire a unit director. That way we can get them trained and start training our staff. Programming is going to be another big part of this. So you're going to have 2 things going on at the same time. You're going to have the building construction and you're going to have the programming construction. My team will do the programming. We're going to probably bring in a consultant to help us a little bit. There's somebody I've worked with in the past who actually is the architect of the Illinois Subpart S rules, which is the special care unit rules, so might as well work with the guy that wrote the rules, he knows them. And he's already been in this building twice to take a look at what our project is going to look like. So you'll be kind of getting, when we get into 2024, you'll kind of start seeing a resolution to bring on another position, the unit director, and stuff like that. So there's going to be a couple different tracks going at the same time, and hopefully bringing it all together when we hit 2025.
And in August, we give the sledgehammer to Teresa and Mr. Kearns to go up there and make the first demolition crash.
I would take a picture and put it on LinkedIn.
You guys really feel like smashing walls. It's therapeutic. My dad's in construction, and as a little kid, he used to bring me on jobs and hand me a hammer and say, "Take it down." And that was awesome.
I could see you going up there and demolishing.
There's not a lot of demolishing. I mean, we're using the outside.
Yeah, I mean,
There's very little demolishing.
I'm gonna break the window.
Yeah, no, because I'm using,
window.
yeah,
We
I'm
need
using
that
that window.
Yes. Right, that's the point. Most of this is being kept.
Just like me.
With the memory care project, most of this is being kept. It's just a reorganize inside the building.
Yep. Yeah, the most demolition is gonna be right around the nurse's station right here. And so we've already talked through temporary walls. My team's gotta figure out, and I just thought of this morning, so they don't know this yet, but the med room is on the other side of where the project is gonna be. So we're gonna have to figure out how we move that med room to a temporary space that meets the double locking requirements. So,
So, I think the question for me, construction is stressful and overwhelming. So how do we support you and your team during the process? Because it is. I mean, anybody's ever done home construction or rehabbed a kitchen, you know what it's like when you've got everything is moved, people are out of there. So what can we do to support you? And you don't have to answer that.
I was gonna say, I don't know that yet.
Yeah, the biggest answer to that is stay out of your way. Let
Well,
you get it done.
there's a, don't
Well, you
micromanage
have
you.
the section, basically, by that time, there's no one there, right?
Correct.
They're gonna put a Visqueen wall up.
No
and
visqueen. It's
Well,
gonna be a
I'm in.
temporary wall, like a full-blown
Okay.
temporary wall.
You got a wall, and you got the
Just do
supervisor
it
that's
sides.
reporting to you, so you just basically got that out of your mind, it don't exist, right?
No,
And it doesn't work that way. There's a lot of coordination that goes into it, but at the end of the day, I've got a great partner in Burroughs. He and I work very well together, and that's why we made the decision not to go with a construction manager and save the money. When I know, I'll let you guys know.
yeah, because Tom, I'm not saying that it is a disruption to normal everyday routine. There are people coming in and out. Elected officials can be a royal pain, and you know what? I mean, they can. And so how do we insulate the people here from people who think you're not spending your money right, who want to try to micromanage? I really feel like part of our job is supporting and insulating unless you screw up royally, then we'll just beat you up ourselves. That's,
I think that's fair.
Okay.
That's fair.
Stay out of his way.
Let me give
We
me.
handle it for other means.
We have other means. Let me give it some thought. I think the biggest thing right now is just keep the ball moving. Because we
Yeah.
got momentum, and as long as we have it, you gotta ride it. So, I know my staff are really excited. I've already had people putting their hat in the ring for being the first one to work on the unit, so we're gonna be in good shape.
yeah, but here's a mantra, right? Even success can be stressful.
Oh, yeah.
So I'm just,
I had hair when I started.
yeah.
And he's only 23.
Yeah, right. No. Double that. Double that. All right, the last thing I got is just public health, give you guys an update. So we've had 5 surveys since January. It feels like every other week, the state's coming in here for something. And so I just break you down the 5 surveys we've had and kind of where we're at. So the one in January was a complaint survey that was self-reported. So if a resident falls and gets hurt, we're required to tell the state that we have an injury, and then they come out and they do a review. If you recall, this is the one where the lift failed and the resident broke her arm. So we got cited for that. We put a plan of correction in. We cleared it. In February, they came in and did our annual survey, which we expected. They cited us with 5 low scope and severity tags. We filed paperwork. They cleared that. In March, they came in and did the life safety code, which is the building, architectural, and safety. They gave us 4 very minor tags. I IDR'd 3 of them. Now, what is an IDR? That is called informal dispute resolution, meaning I don't agree with the surveyor. I have an opportunity to submit my argument. I can promise you they were not read, because one of them was as basic as generator diesel fuel quality test. So the report from the company that came in said the test was conducted and the fuel was found in the acceptable rating. We didn't have the actual fuel quality report, meaning that it had this level of this and this level of that. So the surveyor comes in and he cites it. In the past, it's real simple. I call the company, they send it to me, I file an IDR, here's the document you were asking for. And they said denied. Well, then you didn't read it, because it was done. It was in the report, here's the quality of, they didn't read it. It doesn't matter. the 3 tags were so minor that it's just, again, you file your report, you send them a little bit of paperwork, and it's done. So we cleared that one. Then in April, a couple weeks ago, we had another complaint survey, no, I'm sorry. We had another complaint survey in March for COVID, and there were no findings with that. State came in, she spent the day with us and left, everything was fine. And then 2 weeks ago, we had another complaint survey. This one was on residents' rights and policies. There were no findings at all, and we got a referral from the surveyor for his mom. So I would say we're okay. He's from Winnebago, and he's like, he says when he walked in the door, I've always wanted to get my mom in here. I love this facility. And I said, well, why didn't you put in an application? He said, because we're not from McHenry County. I'm like, that's not a requirement. We take state, federal money. Oh, well, here's my card. Call me, and he puts his personal number on the back. He says, have your admissions person call me. So obviously, we're doing all right. So this is just the process. The state right now is just very heavily punitive and enforcement related. I would anticipate that this is the new norm for a little while, that, you know, you're going to get surveyors coming in and out of the building. Our survey teams love us. You know, this is an easy survey. It really is. I mean, yeah, there are things we do wrong and things that we can improve upon. But when you come in this building, it's an easy survey. You don't have the glaring, oh my God, I can't believe this is happening, or if I'm here to look at this, but I can't ignore what's going on over here, and that kind of stuff. That doesn't happen here. And so we tend to get along really well with our surveyors. When they come in, they're here to do a job. We're here to provide them with information. I think the most recent one, the guy left by 1. So a couple hours in the building, they finish up at home, and we're good to go. So that's the public health survey piece. We're clear. We're out. There's no cycles open. We're back in full compliance, so there's no timelines or clocks or anything that we have to be aware of. So.
Thank you. Any other questions on that? Do we have any future topics that you would like me to write down now so that we make sure we cover in June?
No, but I had one question, and this is just on something I read in the paper. Is it the die-cast that they were gonna do a development on? And isn't that memory care unit and senior living that they wanna
No.
put there?
It's not a memory care. You do live into, like, it goes from independent living to skilled assistance,
it's
but it's
assisted.
not a memory care
I
unit.
thought I read they were gonna put memory care there also.
No.
Even if they have a small unit, it's not going to impact us. The key for us is we are going to take Medicaid and Medicare on the unit, and it's not going to be strictly private pay. No one's doing that.
Yeah,
No one's doing that.
yeah, because even, they have an affordable senior program in the first phase, and I don't know about the second.
Okay, I just wanted to see if that was anything that affected us in the future.
Nope.
When does our budget discussion come up? Is that July?
Okay,
Or
so
is that June?
oh my God, it's this month. In May, we start talking with my team about what the numbers look like. In June, I kind of bring the numbers into a little bit more focus. July, I bring it to you guys, typically. Is that still the same schedule? Yeah, so you won't see it until July.
What's different than what we've been doing every month when you've been nitpicking every detail of penny of money?
Wait till you see the way
Right.
the budget looks.
Yes.
So you don't get hurt with
Well,
all that.
for the new board members, June and July, I feel like it's June and July. Every meeting, you're going through every department's budget.
It's more July and August. now,
More
but
July and
yeah, but
August? Yeah.
You're supposed to follow the budget through your respective committees.
You guys enjoy that.
You gotta really study your levy between each department.
Right. So if there was
This is one
discussion of
levy.
levy, like when we started this committee in January, we had a small discussion about the levy for Valley High and the fact that we're doing a drawback, the county is doing a chargeback. We didn't talk about that ever again. Do we wanna discuss that in the future about we have currently a $10,000 levy on Valley High. That discussion could come up or we could not. And then, in theory, we also could tell the county board we don't want them doing chargebacks like at Valley High too. So,
And that was the $500,000 you're
Yeah.
referring to that we just, this
We
is the
just
first
did.
year we
Yes.
have that on us.
yes.
You wanna see what it looks like when you take that $5,000 out?
500.
So you
The
see what-
500,000?
The 500,000, see what it looks like now? In 2023, it's already in there. And if we just say that's not gonna happen,
It doesn't do much.
there.
Oh, there it is.
Yeah,
That's
it does.
significant.
Yeah, Dominic, I'm like, I didn't do
That's a
anything.
lot, that's, I remember
Right,
that.
yes.
They could- I
Okay.
lost that back.
You know, the good thing is, we have the investments now that are starting to turn some real money. And so when we get a little bit farther down into the month and I start looking at projections and numbers for next year, you and I can have a conversation about where the gap is at. How big is that gap? We're closing it every single month now, even more. The goal was somewhere between 1.5 in your return from your investments. Now, that number might be itching upward because of inflation and whatnot, but if you could cover that, you pretty much cover the whole operation, at least in years past.
Are we off the agenda?
This is future topics. The question
Oh,
was,
okay.
do you want to discuss the chargeback? Do you want to discuss the levy in June?
I think we'll probably discuss all of it, won't we?
Only if we want to.
Okay. I
That's
don't
the
know
question.
enough.
Do we
I don't know
want
enough
to?
to know what I want to discuss.
Well, I think we're
Yes.
almost always discussing it when we're looking at this chart.
Yeah, I think so too.
But, before we
So
adjourn,
no.
just to clarify, right now, we're at the 25 or 26 million around.
Yeah, this
And at
is,
the end of this year, we've got it slated to be 23, 475, 683, right?
yes.
Okay, so at the end of this year, how much of that are we going to allocate for the memory care? All of it?
So,
Roughly, well, 1.5, and then the remaining 2.5 roughly, we don't know what the bid numbers are at.
And is
But
that,
that'll all be in this year, we anticipate.
yeah, 2024 budget?
No, 1.5 in 1 year, and
And-
2.5 the following year.
In the following, so that'll be in
And does that
24.
include staffing? The
Okay.
2.5, so it'll go in the personnel budget for 2024?
No, that is all construction. From a labor standpoint, Scott and I have already started baking that in on the backside.
Okay, but it would be in the 2024 budget,
No,
right? Because
No.
aren't you going to hire somebody, you said in July?
towards the end of 2024, I'll bring you
Okay,
a resolution for that.
okay,
That will be, then we'll add that into our budget.
okay, all
And
right.
then in 2025
It'll-
is when we're actually going to have to work in CNA's activities, housekeeping,
Okay.
and all of that.
But you also have revenue then.
Okay.
correct.
I might not win, so then I might not be here.
Let's think positive.
It's always possible.
You look at
It's
it,
always
almost all 2
possibility,
years
man.
Gloria. Gloria's doing
Gloria's
40.
got 4 year. Yes, that's true.
Yeah.
And Terry's
Terry.
also 4 years.
Yeah.
So technically, they could be.
Yeah, I'm gonna
two
behave
months.
myself too, so that I can stick around until,
Yeah, Gloria and
2026.
Terry are the only 4 years.
Terry and Gloria are the only 4 year people on this
On this
board.
committee.
On this committee,
Which
yeah.
is really unusual that we did that
Yeah.
to me. But anyway, that
Yeah.
answered my question about the end of this year, because you gotta always keep in your mind where our fund balance is without those big expenses, so at least that's the way I've always looked at it.
So before we conclude, I would just like to comment on what a fine job you're doing.
Oh, thank you.
This is not an easy job, I know it's not. And I like the way you handle what happened with the hiring for the ADON and the employee here who applied for that position, to let her know that she's being appreciated and on track for higher things. I think your strategy's excellent.
Thank you. Thank you. The stuff that gets done around here, though, that's not all me. I
Well,
mean,
this-
I'm
the
literally
succession
just
planning,
pointing
though.
people in the right direction. It's the team.
We do have a $20 million life insurance policy on Tom.
All right, so
Don't tell my wife that.
So for future topics, we only are going to be looking forward to the bid coming to us for resolution next month. The
And
committee
strategic
members,
plan.
the committee members have not offered, don't have anything at the moment, but they can tell me later. Do you have one for me? Or you just
For
want-
things that.
Yeah,
deal
or are
with-
you just trying to make it a motion to adjourn?
No, hell no.
Okay.
Why can't we have both of
They
them
shot
to try
now.
to help educate us new guys, your levy and, what was the other one?
The chargeback?
Yeah, just 2 minute or whatever, just get us warmed up,
Okay.
because I'm still kind of confused. I don't see much difference than what we've been seeing, every penny being spent in a budget. I mean, in the end of the day, it's X amount that's got to come here. How you divide it up, that's fine, but the bottom line is you still got that much money to pay X amount of bills. and we've been seeing it every month.
We've not levied for the last, how many years, Scott?
Let's go back,
Except for a placeholder at 10,000.
the 10,000.
Yeah,
8 or 9?
Not advocating, but just to get a more understanding
No, I agree.
of when you throw that out.
At some point, that levy point's gonna cross.
Yeah.
In
Let's see,
about
I've been here for
26.
13, almost 14 years. And I think we did 3 years of levy, so maybe it's been 10 years.
Here is property taxes, so the last one was 2015, and that was just $3 million.
Yeah, that was right before I came on.
And 2016 on, aside from the nominal, in fact, it was 0 the first couple of years, and then it was determined that you need to have something to keep that opportunity in place.
Yeah, because you lose the levy if you don't levy.
Right, because at this point, Valley High is self-sufficient. They are not, some people are like, oh, we shouldn't have a county nursing home. We don't fund it. We don't
Right,
fund the nursing home.
henceforth why you have the chargebacks, because
Right,
they're doing work for you and someone got to pay that bill.
true. So you could say the county was giving away free services, but we weren't actually giving them any money. So, and now we're charging them for their.
Can't
their
commingle
service.
that money.
You can just make the argument that every time I go over there, I'll send them a chargeback.
All right,
No free service.
for $500,000 a trip.
My time is valuable.
Well, but then
But don't charge us for the, great cookies.
the other side of that is that we have a facility in this county that people want to come to from
Right.
other counties.
Right.
They want to come to Valley High. And so I think no matter what, at some point, I guess, and I'm not, I don't have depth in this field. The only thing that I think about, because I think about this in other areas, when we don't do small incremental increases over time, and then we have to jump in after not doing any for 10 years and try to bring that revenue up, it's just so much harder. So if you're very fortunate that we can look at the revenue through investments for you.
Absolutely.
So you don't have to, you're not stuck in that spot.
Nope.
And that is.
We are spoiled.
No, you're careful.
You're fiscal and frugal.
Well, I don't know.
It was an albatross for a couple of years there, I'm just gonna tell you.
Yeah.
Coming from the private sector, I was having a real hard time with this whole, what do you mean I'm not supposed to make money?
Yeah, but the other side of it is, and I'll just say this, you can't get staff. It's hard to find staff when you don't pay. I had trying to recruit social workers, therapists. They're like, why would I do this work here when I can do it in the private sector and make twice as much money? I can pay my school loans and I get to say no. Like when their client list is full, they get to say no. They don't have to double up. They don't have to back up. I mean, I just think that that's something that we're experiencing in many different environments. I'm talking about medical or therapeutic or psychological. We cannot find professionals to work in these fields because we don't pay enough. We don't pay enough. I mean,
That may be just a cycling thing, because you've got more and more private companies laying people off. They're gonna be looking for where
Well, yeah, but-
opportunities are to work.
Carl, the people that work here and the people that do psychological or mental, they're professional. It's a professionalized field, and they're not laying off.
So do we
therapists.
want that as part of our discussions, what we could do if the levy was higher? Is
Well,
that part of the
I would
discussion?
like to. I don't know enough to know what I want to know.
A definition
Well, I
of
will,
what you
I
mean
will
by that.
follow up with Tom and probably
Yeah.
Scott.
Let
and whoever
me-
they tell me to go follow up with us.
Because in the
Who should do
strategic
this
plan is a
discussion?
new recruitment and retention
Yes.
program. So
let
that
me
might
think
address what
about
she
it.
is talking about.
Yeah.
Let me think about how to frame that conversation around.
Okay, reach out to me if you have some ideas.
Okay, I will.
One thing to keep in mind too, when you get into the discussion of the tax levy and the upcoming budget, the tax levy is obviously a substantial county board consideration. You have the opportunity to do a joint Valley High Operating Committee, Finance Committee meeting, so you have both those committees at the table and can have one collective discussion, so.
That's a great idea.
You have that, rather than you kind of going in dark and just, it's an opportunity there, and there may be some benefit when you get into those heavier discussions to have a joint meeting.
One thing important to remember is for your levies, you have P-TEL, the P-TEL laws. Next year, we're gonna be maxed out at 5%, plus the new growth. You can't go in asking for these multi-million dollars because we're an aggregate levy, meaning Valley High is a part of our main levy. And if you take more in Valley High, it takes away from transportation, mental health, the health board and everything else. If that health board wants a big amount of money, then it's gotta come from someplace else. You gotta remember that when you're talking these levies, because I don't think a lot of people understand that. And it takes having to be involved in those levies in the past to understand that, because the common person on the street, meaning myself, never understood that until I actually had to do one of those. That if you take away from, and that was in the township, if you took away from general assistance, it had to go someplace else. And the P-TEL, I mean, you could ask for 10% or 20%, but you're only gonna get 5. And you used to be, only got 2,
And that's why you can't make those decisions or those discussions in a vacuum. You need to
Right.
understand the implications of an increase over here, what it's gonna do to other needs throughout the county.
And that's where I think our budgeting department and Pete are really, really good at that, looking at all the pieces and saying, okay, I gotta put this whole mess together and end up and stay within P-TEL. So that's something we all have to look at in the next coming months, because that's gonna be our argument in November. That's gonna be our big argument. Do you want a levy increase, or do you want a flat levy, or do you want a cut? And I see no way for Valley High, after about 2 or 3 years here, that we can stay where we're at. At that point, it's gonna have to be raised, but I hate to say that, kick the can down the road for a year or 2, but this is one that we're probably still gonna kick the can down the road because of all the other stuff. All the other fund balances are so low.
Well, as long as the investments continue to
Exactly.
do well,
Yeah,
then
exactly.
we're not in an emergent, we have to make a decision now scenario, so we have the luxury of time.
And that's the thing, a couple of years down the road here, we don't have as many funds available to invest, and therefore, now all of a sudden, it grows real quick. And that's when you gotta start doing some levying points. But we have to really pay attention to this levy discussion in every committee you're on, including the ones you're not on. So, that's my,
Just a rub.
Yes, well, no, it is coming up, yeah, so there is no executive session, so is there a motion to adjourn?
Second.
Alright, Carl is first, I'm
Whatever you wanna
Carl
call me.
Kaminsky's first, Gloria